and I welcome you to discuss on alternative means of investment through the commodities market. Over the course of this course, we'll be looking at what we do at AFEX. We'll look at the historical performance of the domestic commodities market, especially the past season. We'll look at why should you invest in commodities markets, how to invest in commodities market, and how to analyze the investments. Then we'll go through a case study reviewing performance of maize in the 2020-2021 trading season. At AFEX, AFEX is a licensed commodities exchange. We started its operation in 2014 with the vision of being the reference point for commodities in Africa. In 2020, we introduced our first cash-settled spot contracts, enabling investors to gain exposure to the commodities market without physically playing in the commodity space. Since then, the exchange has continued to bridge the gap between commodities and capital market through innovative financial products. You might ask, who are our customers at AFEX? Our customers represent our commitment to bring different market participants into an efficient and inclusive market. Our customers include producers, which include farmers, both smallholders and large-scale farmers, farming associations, and traders. Processors that include domestic and international food processors and millers. Investors, which include institutional investors, retail investors, foreign investors, high net worth investors. And how do we provide services to these customers? We use basically two platforms, which are our infrastructural platforms, which include over 93 warehouses across 20 states in Nigeria, and also our technological platform, which is regarded as COMEX, which is basically our order management book. Now we'll look at the historical performance of our domestic commodities market. So over the last 4 years, the performance of the commodities market has shown incredible resilience. Despite the downturn witnessed in the broader investment activity in Nigeria, from 2017 to 2021, the AFEX Commodities Index, which measured 4 commodities in the market, mainly maize, paddy rice, soybean, and sorghum, has returned an average of 33% annually, which is approximately 3 times the average annual return of the Nigerian Stock Exchange or share index in the same period. And when you look at the season-to-date performance, which is the 2020-2021 season performance of the ACI, it has returned over 58% so far, while the AEI, the AFEX Export Index, which comprises of cocoa and ginger, has returned over 20%. Then when you look at the individual commodities themselves, in the 4-year span, our maize has returned about 27%, sorghum has returned over 38%, soybean has returned 37%, while paddy rice has returned an average of 17%. So, for you to understand how the domestic commodities ecosystem works, you have to understand the demand and supply dynamics. So, in late 2019, the federal government banned the imports of most grains in the country. So, and before the ban of the importation of these grains, our domestic consumption was supplemented by foreign supply. And over the years, the country has significantly improved its productive capacity. However, there is still a gap between the demand and supply dynamics in the country, and our domestic supply has not been able to meet the domestic demand, thereby causing a significant gap. And these dynamics have led to the surge in the price of commodities in 2020 and 2021, and which has ultimately translated to a higher price level and erosion of capital. So the chart below shows the supply and the demand dynamics. with the gray color bar charts signifying consumption, and the red color line chart signifying production. So as you can see, our production is lagging the consumption across maize, soybean, rice, with the exception of sorghum. So if you look at the maize price per metric ton historical price movement, it has been on an upward trajectory. The same thing with the soybean, paddy rice, and sorghum. And as I've explained before, the main reason for this is the demand-supply dynamics in the country, which has caused a gap between the demand and the supply. These are some of the factors that shape the 2021 domestic commodities performance. The number one factor is the rising cost of production. So the surge in energy prices, mainly your natural gas, has translated to an increase in fertilizer prices in different parts of the world. This is because urea, which is the main component of fertilizer worldwide, is derived from natural gas and has witnessed over 200% increase just last year alone. And this has led to an increase in price of commodities worldwide. So when you look at in 2020, there was the COVID-19 lockdown, and this led to reduction in demand nationwide. But as a result of the lifting of the lockdown in late 2020 through 2021, there was more renewed demand, and this high demand level saw prices hit new highs because the supply can meet the demand. Also, in the country, there is the pending structural challenges we are facing, ranging from low production, low absorption capacity, infrastructural gaps such as lack of adequate transportation, and we even still have some issues with the security challenges across the country. All this culminated in increase in prices that we witnessed in the past seasons. Also, we have the transitory effect of FX movements. Research has shown that there is a strong correlation between the Nigerian parallel market rates and price movement in commodities. So when there is a valuation of the currency, the price of local commodities have also increased with the valuation of the currencies. And another issue we faced in 2021 is the holding activities of traders. So traders have realized that if they can just keep their goods at the beginning of the season, instead of selling it, they can sell it for a higher price later during the season. And this also put an upward pressure on the commodities performance locally. And also, due to the devaluation of Naira and its weakened states against the CFA, which is the predominant currencies in our neighboring countries, it's cheaper for our neighboring countries to actually export our goods through the border. And this has led to a lower supply for our domestic commodities. So why should we invest in commodities? What are some of the benefits of commodity trading? Commodities are usually referred to as alternative investment, as they not fall in your traditional equity or fixed income investment. In developed countries, there are diverse means to which one can gain exposure into commodity space. This can be either through direct ownership of farmers, or through innovative financial products that are commodities linked. The two major benefits that commodities investment will give you is that in recent times we've witnessed devaluation of our currency, and this has led to erosion of your capital. So by investing in commodities, you can hedge the risk of currency devaluation. As the chart below on the left side below, I show the correlation between the AFEX Commodities Index and the Nigerian Nigerian dollar rate is over 0.68%. what this signifies is that as the devaluation is going on, the AFEX Commodity Index is also keeping pace with the valuation. Then you look at portfolio diversification. So portfolio diversification is basically the process of investing your money in different asset classes and securities in order to minimize the overall risk of the portfolio. So instead of investing all your money in either in traditional investment categories such as equity and fixed income, you can diversify your risk by also investing in commodities. How do you analyze your investment in commodities? So there are two main ways for you to analyze your investment in commodities. We have the fundamental analysis and we have the technical analysis. So why do you even need to analyze your investment? So it is very important for potential players such as yourself and to understand the domestic commodities market before exposing yourself to the market, as there are some specific factors that affect the local commodities ecosystem. So, as I said, we have two main techniques of analyzing the market, the fundamental analysis and the technical analysis. The fundamental analysis is a method of forecasting the performance of the commodities market by examining related economic factors. Some of these factors are macroeconomic in nature, such as the state of the economy, the inflation rates, the interest rates, the producers and the consumer sentiment towards specific sector or specific commodities. Then we have the technical analysis. Technical analysis is just the study of past trading activities and price change. It's you analyzing the volume and price of commodities that was traded in the past for you to predict what will happen in the future. So this slide is still talking about the fundamental analysis of commodities. So, and fundamental analysis mainly revolve around the relationship of supply and demand, which is complex, global, and ever-changing. So fundamental analysis involves tracking and understanding multiple variables, such as the demand-supply dynamics, the macroeconomic conditions in the country, the climatic conditions in the country, and some of the government policies that can affect the commodities ecosystem. So this slide is showing some of the technical analysis method of analyzing the commodities market. So these are just charts that are showing the historical and present price and volume movement in the market. So we have the candlestick analysis, which is generated through the up and down movement in prices. So while this movement might seem random, experienced traders use them to forecast short-term price movement in the commodities market. We also have a trend line analysis, which helps analysts to predict what could happen in the commodities market. We also have our volume analysis, which involves examining relative or absolute changes in commodity traded volume in order to make inferences or prediction about the future price movement. So some of these techniques are a little bit complicated and it involves a lot of analysis and it involves a lot of expertise. So we now look at the case studies of historical performance of maize in the past season. So 2021 was an interesting year for maize in Nigeria as the recovery from the global pandemic exposed the need for us to build a self-sustaining economy in the country and attain food self-reliance and resilience. The inability to access the international market for commodities by domestic players was further worsened as the AFEX Bank, which is the Central Bank of Nigeria, began restricting the access for foreign exchange prices for grain importation. As such, domestic consumption was restricted basically to domestic supply. And as I highlighted before, when the domestic supply cannot meet the domestic demand or consumption, it will lead to increase in price. And this is demonstrated by this chart, where at the beginning of the year, maize A metric ton of maize was going for around 160,000, and by the close of the year, it rose to over 200,000 naira per metric ton. And over the course of the year, it rose as high as 250,000 naira metric ton per year. And the importance of maize to the typical household in the country cannot be overemphasized, as has been shown by research over time. So as a result of the pivotal role maize plays in our diet and consumption in the country, it led to this increase in price because the demand for maize was high, both from individuals such as yourself and I, and companies such as milling company, food processors, and others. So on the lower right part, we have some of the scenarios that can affect the maize price. So ranging from disposable income, aggregate demand, and government policies that can affect the maize price over the course of the trading season. Now we'll be looking at some of the products available on AFEX Commodities Exchange. So basically, we have 5 types of products in the market, ranging from spot contracts and fixed income contracts. So the fixed income contracts, as you can get from his name, gives you a fixed return over a short period of time. While the spot contract tracks what is happening in the market itself, and this should be reflected in your investment. So under the fixed income contract, we have basically 3 types, which is the asset-backed commercial paper known as the ABCP, which usually have a tenure of 270 days and has a risk profile, a low risk profile. We also have the trade finance notes, which usually have a tenure of less than a year, and also have a moderate to low risk profile. And we have the immediate finance notes, which has a high risk profile and has a tenure of less than a year. So under the spot contract, which is the common contract where the retail investors participate in, and is a securitized version of our physical commodities. So it involves assets that are backed by physical commodities stored in our warehouses across different locations in the country. And the returns depends on what happens in the market itself. So it's not fixed return. It depends on if you invest in maize, for example, if the price of maize in the market goes high, your investment go high. If the price of maize in the market contract, also your investment returns also contract. Then you have your ETC, which is just the exchange traded commodities. So this is like a basket of many commodities, about 3 to 5 commodities together. And this is just to track and replicate the underlying commodities. So it's not a fixed income instrument also because it tracks the underlying commodities. Although sometimes we package it and we guarantee a specific level of return. So let's say we guarantee 15% return. So what this means is that the lowest you can get is 15% on this ETC, or you can go as high as the underlying commodities perform over the course of the season. And we've now come to the end of our presentation. Thank you for joining.